In 2026, the traditional 60/40 portfolio isn't just outdated, it's a liability. We are living through a structural transformation where AI, the global power grid, and national security have converged into a single massive trade. But most investors are still playing by 2020 rules. Today, I'm breaking down the 2026 Sovereign Investment Playbook. After achieving a multi-million-dollar portfolio that allows me to live a work-optional life, I've realized that wealth in this decade isn't about chasing green candles. It's about portfolio allocation and risk management. I wanted to build a portfolio that can survive bad outcomes, participate in the good ones, and avoid the catastrophic mistakes of the hype cycles. We are going deep into the energy compute nexus and why I'm hedging against the US dollar with alternative assets, physical commodities, and forward currencies. This is the blueprint for 2026. The first and most critical theme is the energy compute nexus. We've moved past the AI hype phase into AI monetization. It's time to build real businesses. The market is no longer asking what AI can do. It's asking how we're going to power it. Data center capacity is projected to reach 82 gigawatts by 2034. To put that in perspective, that's equivalent to the electricity consumption of 66 million US households per year. In January 2026, the PJM Board of Managers launched an emergency plan to integrate data centers because the load growth is hitting a breaking point. We are looking at a 19 gigawatt power gap in the US by 2028. The bottleneck for AI growth has shifted from chips to electrons. My focus is on uranium and natural gas. Nuclear is the only carbon-free power source that scales, and the US government seems to agree as well. Look at NLR for broad exposure to the space, or companies like UUUU and LEU, which are critical for the domestic uranium supply chain in the United States. However, it takes time for nuclear reactors and development to come online. So we're looking at natural gas as the bridge, so companies like EQT can benefit. As the US administration focuses on energy independence, power generation is the primary mandate. Theme 2 is the Great Physical Realignment. We are entering the most significant copper supply deficit in 22 years. With LME futures recently touching more than $13,000 per ton, the market is reacting to the fact that you cannot build the grid without it. I prefer COPJ to play the junior copper miners with potential for increased returns, but it's definitely going to be very volatile. In 2026, the US dollar is facing debasement pressure due to aggressive fiscal stimulus, growing inflation, and declining credibility of the US dollar as a safe haven currency. Gold is my portfolio's ballast. Rare earths are the new geopolitical leverage. I'm watching PPTA closely. They control the largest domestic source of antimony, a critical mineral for defense munitions that China currently controls 85% of. Theme 3 centers around 2026 as a US midterm election year. Volatility is guaranteed. Trump's approval ratings are down across the board. Trump historically uses the S&P 500 as his primary scorecard. Currently, the Republicans hold majority in both the House and the Senate in the United States. If they lose seats in the midterms, it becomes harder to pass policies in the final 2 years of Trump's term. With 40% of the US market directly owned by US households, the administration cannot afford a sustained drawdown in the markets. In order to avoid a potential political gridlock, Trump will do whatever he can to prop up the economy, support small businesses, and improve household wealth. Midterm election years tend to see high volatility and potential drawdowns leading up to the election. I expect Trump's administration will do all they can to backstop the economy to help the equity markets bounce back. If we do end up seeing a bigger drawdown of 10 to 15% sometime in the spring, then we should be comfortable buying the dip due to the pressure on Trump to support the market. This played out a number of times last year as market pressure made Trump backpedal on his policies. For example, when he threatened 100% tariffs on China, this was de-escalated by the weekend. Inflation won't deter Trump from aggressive fiscal stimulus. The term of the current Fed chair, Jerome Powell, is coming to an end in May this year. It is likely Trump will select an individual that will align with his policies. On top of that, Trump has made it clear that he will grow his way out of the government's debt. Growth will be priority, while inflation will be in the backseat. Throughout 2025, Scott Bessent, the current Treasury Secretary, has quietly supported stability in both the equity and bond markets during volatile times. The biggest example is Bessent's proposed reforms to liquidity ratios, or the minimum percentage of total deposits a bank must maintain to cover debt or net cash outflows as part of Bessent's plan to prop up the U.S. bond market to keep Treasury yields in check. So what's the strategy here? This is not financial advice. My base case is that we will see some weakness sometime in the spring, but Trump and his administration will do whatever it takes to position for a strong recovery going into the elections in November. I'm trimming winning positions to raise some cash to buy the potential dip. My cash target is about 20 to 25% of my portfolio. 50% of this will be in traditional safe haven currencies like the Swiss franc, while the remaining will be short-term treasuries, bonds, or cash. Now, let's talk about where the capital flows if the US dollar debases. While most people look at Bitcoin, I am looking at the continental pivot to China. One of the reasons I'm spending time in Asia this year is to see this infrastructure build out firsthand. You can't understand the electron gap from a spreadsheet in New York or in front of your computer. You have to see the scale of the nuclear and solar farm east. In 2026, the narrative has flipped. While the US is struggling with a power crunch that's stalling data center growth, China is sitting on over 400 gigawatts of spare power capacity. According to recent data by Goldman Sachs, China's power market is now twice the size of the US, giving them the unique ability to fuel AI clusters without destabilizing their domestic grid. So the play is that we're in the first year of China's 15th five-year plan. The focus has shifted from ghost cities to AI sovereignty. I am positioned here through KWEB for broad China exposure. Or you could play specific companies like Alibaba or JD. These companies are no longer just e-commerce. They are the primary adopters and monetizers of China's AI agents. And even Jensen Huang mentioned that China will probably win the AI race. At a 20x forward PE, the valuation gap between the US big tech and China big tech is too wide to ignore. In a world of dollar debasement, China is the value play with growth characteristics. I've allocated a portion of my own portfolio here because China is winning the race to scale AI, while the US is still fighting over permits to power it. Now, to the last theme, which makes up a very small portion of my portfolio, about less than 1%, but deserves special mention. Collectibles like art, retro video games, trading cards, wine, and luxury bags are surging due to perception as a scarce product with limited supply. Having achieved financial independence, I have a lot of free time, as I don't have to work a 9 to 5 to pay my bills. So I spend a lot of time in these categories because I enjoy them as hobbies first and foremost. Trading card games like Pokemon and One Piece have fixed or decreasing supply. As I travel, I see the global demand for these products, or what they call alternative stores of value. And remember, it is about perception. So these alternative stores of value are increasing while the paper cash is continuously losing purchasing power. In my last trip to Japan, I visited a lot of card stores and talked to the employees. And one employee noted how many foreigners are buying up One Piece and Pokemon booster boxes and singles in large quantities. Trading card games have seen explosive growth, especially Pokemon and more recently One Piece. But this is also happening across the category if you look at Riftbound, Gundam, and others. Since 2004, Pokemon cards have returned nearly 4,000%, outpacing S&P 500 return of 480%. But what's the catch? The trading card market is highly vulnerable to price manipulation and thin liquidity. The overall Pokemon card market cap is $12 billion, which pales in comparison to a single Fortune 500 company. My plan is to continue to enjoy these as hobbies, first and foremost. But I will trim my collection to take advantage of the price run-up and get back my initial expenditure. After all, shiny cardboard is shiny cardboard. A portfolio isn't about a number. It's about the ability to ignore things that don't matter. Because I've built this architecture, I don't have to react to every headline or election poll. I can spend months slow traveling, absorbing new cultures, and because my portfolio allocation and risk management, my equities, my commodities, and my alt assets is doing all the heavy lifting for me. Build a portfolio that serves your life. I'll see you at the next destination. If you like these types of videos, please like and subscribe, and I'll see you next time.